Picture this. You're a homeowner in New Jersey paying $15,000 a year in property taxes and $20,000 in state income taxes. Under the old rules, you could only deduct $10,000 of that $35,000 total on your federal return. But starting this year, that's changing dramatically, and it could save you thousands. What is the SALT deduction? SALT stands for State and Local Tax Deduction, and it's been part of the U.S. tax code for over a century. This deduction allows you to reduce your federal taxable income by the amount you pay in state and local taxes, specifically state income taxes and property taxes. Think of it as the federal government saying, we recognize you're already paying taxes to your state and local governments, so we won't double tax you on that money. The big change from $10,000 to $40,000. On July 4th, 2025, President Trump signed the One Big Beautiful Bill Act into law, and buried within this massive tax legislation is a game-changing provision. The SALT deduction cap jumps from $10,000 to $40,000 for the 2025 tax year. That's a 300% increase, but here's the catch. It's temporary. The timeline, a 5-year window. This isn't a permanent change. Here's exactly how it works. 2025, the cap increases to $40,000. In 2026 through 2029, the cap increases by 1% each year. So $40,400 in 2026, $40,804 in 2027, and so on. But in 2030, the cap reverts back to $10,000. So you have a 5-year window to take advantage of this expanded deduction. The income cliff, the $500,000 threshold. But wait, there's a significant catch that creates what tax experts are calling a SALT torpedo. That expanded $40,000 deduction begins to phase out for taxpayers with modified adjusted gross incomes over $500,000. For every dollar you earn above $500,000, you lose 30 cents of the SALT deduction benefit. Here's where it gets interesting. At $600,000 of income, the deduction drops back to just $10,000, meaning you've lost the entire benefit of the increase. The SALT torpedo effect. This creates a bizarre tax situation. Between $500,000 and $600,000 of income, some taxpayers could face an effective tax rate of 45.5% on that $100,000 slice of income, higher than the top federal tax rate of 37%. Why? Because as your income rises in that range, you're not only paying more in taxes on additional income, but you're also losing a valuable deduction, creating a double hit. Who benefits most? The biggest winners are clear. Homeowners in high-tax states like New Jersey, New York, Connecticut, Illinois, and California. According to Realtor.com, 40% of homes in New Jersey are taxed at over $10,000 a year, followed by 26% in New York and 19% in Connecticut and California. But remember, you need to itemize your deductions to benefit from this change. About 90% of taxpayers currently take the standard deduction and won't benefit from itemized deductions like SALT. Real-world example. Let's say you're a married couple in California with a $450,000 income. You pay $25,000 in state income taxes and $15,000 in property taxes, totaling $40,000 in SALT payments. Under the old rules, you could only deduct $10,000, leaving $30,000 of your state and local taxes not deductible. Under the new rules, you can deduct the full $40,000 in 2025. This could reduce your taxable income by an additional $30,000, potentially saving you thousands in federal taxes. The business workaround remains. Here's something particularly interesting. The law preserves pass-through entity tax workarounds that allow business owners to sidestep the individual SALT cap altogether. Many states created these workarounds after 2017, allowing partnerships, LLCs, and S corporations to pay state taxes at the business level, where there's no cap, rather than at the individual level. Planning considerations. If your income might hover around that $500,000 threshold, timing becomes crucial. Tax experts suggest you may want to reconsider Roth IRA conversions, realizing large capital gains, or other moves that could boost your income into that penalty zone. The broader context. This change is part of a much larger tax package. The standard deduction also increases to $15,750 for single filers and $31,500 for married couples in 2025, meaning fewer people will itemize and benefit from the higher SALT cap. What this means for you. The bottom line, if you're a homeowner in a high-tax state with significant state income taxes and property taxes, and you earn less than $500,000, this could be a substantial tax break. But if you're in that $500,000 to $600,000 income range, you might want to talk to a tax professional about income timing strategies. Final thoughts. The SALT deduction increase represents the most significant change to state and local tax policy since 2017. For the right taxpayers, it's potentially worth thousands of dollars per year. But like all tax changes, the devil's in the details, and in this case, those details include income thresholds, phase-outs, and a ticking clock that makes this a 5-year opportunity. Whether you benefit depends on where you live, how much you earn, and whether you itemize deductions. The key is understanding these rules now so you can plan accordingly. I'll see you later.